The revaluation of gold and silver is likely to happen faster than the unwinding of the billions of dollars of bearish derivative bets against a higher gold price, which threatens the anchor of a 1 quadrillion of David derivatives and the collapse of the largest ETF, GLD. The BRICS currency basket, which includes gold, oil, and silver, has been in development for over 2 years, but progress has recently ramped up exponentially. With the dollar already weaponized, this commodity currency basket will be phased in years earlier than anticipated. The reason silver figures so high in the weightings is that it is the most undervalued and short-sold of all the commodities on the list. JP Morgan and Standard Chartered, anchor liquidity providers, exited the base metal space following the nickel blow-up. Paper market liquidity supporting decades-old derivative structures will thin out dramatically, and this will feed into silver, causing it to outperform proportionately to the upside. The longer-term and more important driver to reset and benchmark the far next train change paper gold price against a physically derived global supply-demand prime is the unfactored commoditization of the BRICS currency basket, which has accelerated the process of gold being revalued. The current ratio of gold to foreign debts outstanding after recent money printing has now shrunk from 6% to under 5%. The ratio is significantly below the 20 to 40% historical average that the Bank of International Settlements likely expects the ratio to ultimately revert to into the implementation of Basel III. The migration of the oil trade and the recent Russia-China alliance, which accelerated the commoditization of the ruble under yuan, poses an unfactored threat to the unbacked US dollar. Silver has been acting extremely poorly, and this is directly related to the cutting of this OCC derivative position. The millions of ounces that have been sold short and its direct relationship to SLV enable any physical buying to be flywheeled and not purchased. The gold-silver ratio is currently at a ludicrous 86 to 1. But that puts silver at a minimum between 70 and 140 pounds. If we look at 1980 levels, that could potentially put silver at $580 an ounce. Once gold breaks loose of its unallocated collar, silver's fair value could be somewhere around $375 to $750. If the dollar fails, it won't be good, and if the dollar really fails, it won't be gold trading at $2,500 an ounce. Higher physical prices will bring physical to the market, and a real physical price will settle. We don't know what that is, but it's a hell of a lot higher than the current price. As mentioned earlier, the current gold-silver ratio is at a ludicrous 86 to 1, which is significantly higher than the historical average of 20 to 40%. This suggests that silver is undervalued and has great potential for growth in the future. Moreover, the implementation of Basel III NSFRs was aimed at achieving the revaluation of gold against a physically derived global supply-demand prime. However, the weaponization of the US dollar has brought this onto the front burner much faster than anticipated. This global imbalance must be normalized, and the unfactored commoditization of the BRICS currency basket has accelerated this process. Therefore, gold must be revalued at a much faster pace than was planned. It is essential to understand that the revaluation of gold will have a significant impact on silver. Silver has been acting extremely poorly due to the cutting of this OCC derivative position. The millions of ounces that have been sold short and its direct relationship to SLV have enabled any physical buying to be flywheeled and not purchased. However, once gold breaks loose of its unallocated collar, silver is going to change. This is because silver is a deliverable global foreign exchange currency cross trading alongside the dollar, the euro, the yen, etc. It is a central bank organized commodity that is required to fulfill the BRICS commodity basket. Therefore, it is highly likely that physical silver investments will be required to fulfill this basket, which will put significant pressure on the already thin market for physical silver. This could lead to a short squeeze on silver, and the gold-silver ratio could become magnetic. Once we see the unwind of the unallocated collar, silver's fair value is likely to be around $375 to $750. If the dollar fails, this could lead to a significant increase in silver prices. To conclude, the revaluation of gold and silver is likely to have a significant impact on the global economy. The current gold-silver ratio is significantly higher than the historical average, suggesting that silver is undervalued and has great potential for growth in the future. The implementation of Basel III NSFRs was aimed at achieving the revaluation of gold against a physically derived global supply-demand prime. However, the weaponization of the US dollar has brought this onto the front burner much faster than anticipated. This global imbalance must be normalized, and the unfactored commoditization of the BRICS currency basket has accelerated this process. Therefore, gold must be revalued at a much faster pace than was planned.